Welcome to the Stockout, another turbulent day. I am your host, Mike Baudendistel. Grace is out. Some much needed escapism on a day like today with the market melting down. But this is a show, the Stockout, that's focused on retail and CPG industries. I'll try to keep this discussion focused more or less on those industries. I'm not going to try to repeat things you've heard on the tariffs that you've seen in 100 other places. So I'm going to go through a couple of articles that are up on FreightWaves.com that are very relevant for CPG and retail. I'll also go through some of the reactions that we've seen in those industries from various industry associations, from various companies that are within those sectors, and then go through a little bit of what we're seeing in SONAR, which really the SONAR data platform gets to be more and more valuable the more turmoil and uncertainty it arises in freight transportation industry. Just having that real high frequency daily data, shows you what's happening. It was a huge, gave huge insight during COVID. I think it's going to give huge insight during this tariff situation. But before I do all of that, I want to encourage everyone to sign up for the Stockout newsletters. In addition to all the other great newsletters you can sign up for on FreightWaves.com, all you do is go to the site, go up at the top under newsletters. Second one under market insights there is the Stockout. That's going to be the best one, but the other ones are, worthwhile as well. So I encourage everyone to do that. And with that, would like to get into the first, topic today, which article up on the site, the Port of LA expects a second half volume drop off. This was something that Stuart Charles wrote up. He does a great job of following the ocean industry, really has a lot of frequent articles up on the site that just keeps you really just informed on just all the sort of nuanced, issues, things like the Red Sea situation, the volume, the rates, all those things. And what's really stood out to me from this article is that he's quoting Gene Seroka, who is the Los Angeles port director, and he's really the face of that port. I mean, we sort of see him all the time on our shows and elsewhere. And, oftentimes he's pretty bullish, maybe just realistic and what he's been seeing the last, however many, years, he seemed to have been very bullish and sort of rightly so. And so to have him come out and say that import traffic at the port of LA is going to drop off at least 10% year over year in the second half of the year. I think there's really a lot of credibility there. And I think that makes a lot of sense. So basically he expects to start seeing those types of year over year declines beginning July 1st and through the end of the year. And this comes after several months where the port reported either record volume for that particular month of the year or just a near record. And in general, the Port of LA has been posting import volumes that are about 15% higher than what is typical normally. So it does seem like there's been a great deal of pull forward, really starting, before the election, maybe kind of the middle part of last year. There's anticipation, I think, back then that there would be that there would be tariffs. I think that accelerated with the with the election, and then accelerated further as the rhetoric has strengthened, and at some point that falls off and inventories get to be too bloated. We can look at this kind of graphically in SONAR, and this is a SONAR data set that that I watch every day. It's the inbound ocean TEU volume index, and what this measures is the demand to move ocean shipments at the point of origin, which in many cases is Asia or China specifically. I think when you're looking at IOTI, US LAX, you're really having it disproportionately be China as the origin. And what this shows is you look at last year was in that green line, and really the import demand started taking off in June, and it stayed elevated for final 7 months of last year. Was even a little bit above that level, this year, really strong right before the Chinese New Year. Then you always see the drop off in February for Chinese New Year. And then demand came back, fairly strong, after that. And, even with that strong demand, you're seeing the ocean rates, come way down, So, still from the data that we're seeing on demand, it still shows it being elevated. If you have volume that is booked in, let's say now, first week of, 1 week into April, probably hits the US LAX, let's say 15 days or so, from now. So I think you're going to start to see this fall off before you see those import volumes start to come down. But this is going to be a data set to watch to see if Gene Seroka's expectation is correct. But it does seem reasonable given what we've seen with inventories at some of the warehouses. Saw the other day that Flexport said that its warehouses had gone from being about 50% full to being about 75% full. Some of the other things that Gene Seroka cited, that was quoted in that article is that, yes, there's been a pull forward and inventories are getting a little bloated. It also says that companies are continuing to source goods in locations other than China when possible, sort of despite the fact that the tariffs that were announced last week, I think, were a lot more widespread, as well as just a lot higher than people anticipated, particularly in some of those Asian countries that are not China, countries like Vietnam and Cambodia, where you really have the high trade imbalance between those countries, and we also imported a tremendous amount. It ended up being this really simplistic methodology based on those two factors for what the tariff ended up being. So these goods from Southeast Asia, as far as the port of LA is concerned, less likely to go through that port just because there's more likely to go through Suez Canal, assuming that the Red Sea is opened. But Gene also says that sort of the middle part of the year, companies start to pull back on shipments, not just because of inventory levels, but because of, okay, you're getting close to the end of the year. A lot of sort of higher ticket items have model years, kind of the same way that automobiles have model years. And then you start to say, well, okay, start to pull back because we're going to need that space for next year's model year. We don't want to have to discount towards the end of the year into next year. So the expectation there is that eventually volumes fall off at the port of LA. That translates into lower intermodal volume, which the intermodal volume has been very strong. We're actually much stronger than the truckload volume, but then also it could lead to lower demand on the truckload side as well. So we pay attention to Stuart Churl's article about Port of LA and the ocean market in general. I want to move on to the next topic here, which the de minimis exemption revoked for Chinese e-commerce shipments. This has been something that had been anticipated. It was something that President Trump moved to do immediately, and then he backed off on because they didn't have the sort of the systems in place because just the huge amount of volume that comes in that falls under the Chinese e-commerce shipment. I mean, something like 1.3 billion packages a year come in, that qualify for this, de minimis, the lower than that $800 value. And so basically what happened is Trump ordered U.S. government to end the duty-free treatment for small dollar shipments from China to Hong Kong effective May 2nd. There's really a tremendous amount of detail in the article that's up on the screen that was written by Eric Kulish. He goes through, a lot of the detail, and then he talks about how, the implications for the ocean sector, the air freight sector, particularly because a lot of this moves air freight, basically the Shein and Temu, business model, which relies, heavily on air freight because it's a made to order business model. And so the pretext of that getting rid of the de minimis is that's a way to cut off illicit imports of synthetic opioids and also level the playing field for domestic retailers. I do think the leveling the playing field with other companies is legitimate. I mean, you sort of look at what Shein and Temu have paid in import duties the past several years, basically nothing, versus what H&M or Gap, and it's hundreds of millions of dollars. So there does seem to be some need to level those playing fields. These low value goods now are going to be subject to all duties imposed on Chinese products, including the new 34% tariff under the global reciprocal trade enforcement policy. Whether you consider it to be reciprocal by your own definition or not, another question. And that 34% tariff is on top of a 20% tariff imposed earlier this year. And now the average U.S. tariff on Chinese exports will be 50% starting April 9th. That's in a couple of days, according to Peterson International Economics. And so this really does, potentially change the competitive dynamic of a lot of the Chinese e-commerce companies, and is also rolling out new regulations for items sent through the International Postal Service, which no longer qualifies for the de minimis exemption. Eric goes through that in his article, talks about how they want to make the only thing that's going through this International Postal Service just be letters, no packages, packages subject to pretty substantial fees, $25 or $50 a package, and want to make sure these large e-commerce companies don't use postal channels for these bulk deliveries. But it shouldn't be a concern if we're talking about Shein and Temu specifically, because those companies don't use postal service. They say, well, it takes too long, it's unreliable. There's some difficulty with the translation aspect of it as well. So for now, the import de minimis exemption is going to remain in place for countries other than China, but that does seem like that is going to be removed once Customs and Border Protection is set up in a process in a way to handle the very large volume of de minimis that was coming in. That was really the only reason why it wasn't in place already. And really big implications here for the air freight sector specifically. I want to bring up a chart on the Drewry air freight rates from the Shanghai airport to LAX, which you can bring in SONAR. Now you have it at $3.15, and really kind of back to pre-pandemic levels. There you see the chart on the screen now, and sort of before the COVID era, you basically have a situation where it is inside that $3 per pound range, with the exception of certain holiday or peak season where it spikes up to maybe $5 or $6, and then with the change in the air cargo availability, less business travel, more leisure travel, the business travel cargo belly space much more valuable than the leisure travel belly space for the most part. Rates shot up. They've been kind of elevated ever since, and now finally they're back down to what it appears to be kind of pre-pandemic levels. And a large part of that was the lack of availability of belly space with less business travel, but then also just the absolute explosion in these e-commerce shipments. Eric in his article talks about how that's grown over the years, and it's been almost kind of parabolic how much the e-commerce shipment. So it'll be very interesting to see just how much that's reversed in the coming months. A lot of these e-commerce companies are starting to change their business models, to have a little bit more traditional distribution model where they're moving in, bulk, volume of commodities into the U.S. and then it's fulfilled locally. And then he has an interesting stat in there: e-commerce shipments account for about half the volume from China to the U.S. and about 6% of global air freight demand. So sometimes you take out that a few percent, and it just completely changes the balance of the markets. Now the charter flights and space reservations since February, some of those have been canceled, and the air cargo volume was flat in January after growing double digits throughout 2024. So the air freight industry in a very different place than it was just a few months ago. I want to move on to the CPG industry and how the CPG industry is reacting to the tariffs. And the CPG industry is represented to a large extent by this Consumer Brands Association. We've had them on the Stockout before. We've had them on other shows and at our conference before. This is a major trade group that represents packaged goods companies, and really represents most of them. So they're called for the tariff exemptions to be more targeted, I think was their main message. They want the tariffs to be exempt on scarce ingredients and inputs. So I think they have they make a good point there. They also do make the point that the CPG industry manufactures most of its products in the US already. So there's really not a lot of manufacturing to bring back to the US. They say it accounts for, by their count, 22.3 million American jobs, the CPG industry does. So really a tremendous number there. And they do say that, despite all this manufacturing, you just can't possibly physically do everything in the US because there are certain critical ingredients and inputs that need to be imported. No amount of tariff is going to bring that back. And this is pretty intuitive because there's just certain ingredients that can only be grown in certain locations. And you can sort of go down the list, like cocoa, pretty specific to the Ivory Coast, parts of West Africa, certain fruits like tropical fruits, coffee, palm oil is largely Indonesia and Malaysia, certain things like oats, spices. And then there's really a lot also in packaging that some of these companies are concerned about. They're concerned about the tin, mill steel being subject to tariffs. The Consumer Brands Association is urging Trump administration to exempt aluminum and steel products that are not available in large quantities in the U.S. Had some of those issues during COVID where there weren't enough, beer cans and beverage cans, had to start, importing those, whereas they were enough, in the U.S. initially. Some of the companies that have come out with comments that want the Trump administration to have a more targeted approach include Pepsi, Conagra, and Smucker. Smucker owns a lot of the coffee brands that people use in their homes, like Folgers and a number of others. So there, really no way to source those other than importing the coffee. Fortunately for them, some of those countries are some of the ones that are maybe are on the lower side in terms of tariffs, because just a lot of the higher tariffs are Asia. The lower tariffs are kind of this Central and South America, and the biggest locations where we're sourcing coffee from are Brazil, Colombia, some of those countries in Central and South America. But in one line, CPG industry wants this to be a fine-tune approach. They don't want it to be kind of an overarching approach. The National Retail Federation, moving on to the next topic, they also had some comments on the tariffs. I thought leading up to the tariffs, they had stronger expectations going in, not expectations, but stronger rhetoric against the tariffs, where the National Retail Federation, I would say, is more against the tariffs than the CPG industry is, but they do expect it to slow consumer spending. So that's kind of concern number one. And the concern number two is just that the products are going to be much higher, and there's just no other way to source the manufacturing of apparel and shoes and textiles except from internationally. So some of the stats that National Retail Federation cites, they're expecting retail sales this year to grow between 2.7% and 3.7%. For reference, last year was 3.6. So basically, they're expecting it to be no better growth than last year, probably worse than last year. And we think about sales growth of 3.6%. Most of that is just price levels, inflation, not a lot of growth beyond that. So it doesn't sound like the Retail Federation is terribly bullish, and several analysts expect the tariffs to hit the apparel industry especially hard. Part of that's because there's kind of nowhere to hide as far as moving in apparel. And if the apparel is not made in China, it's probably made in one of those countries in Southeast Asia, which is also going to be subject to these very high tariffs, which surprised the stock market to the upside. You probably saw Restoration Hardware sort of melt down as their earnings call was going on. Did look at that 10K reference that was the 10K section that was referenced. Heavily areas like Vietnam. And so this United States fashion industry came out also against the tariffs, saying that despite the fact that they've been subject to high tariffs for a number of years, the percentage of apparel made in the U.S. is just 3%. And that's despite tariffs that have been in place in the apparel industry, paying higher tariffs. They view that as evidence that higher tariffs does not bring jobs, back to the U.S. It does nothing but increase the price of, clothing, shoes, et cetera. I did, however, find one company that likes the tariffs. It is the resale platform 3UP, They're Up, or Re-Up. I'll check that one. But this is a resale platform, and they like the fact that there's tariffs, so less competition essentially from newly manufactured clothing that's overseas. And this resale platform, the quote is, "This is a significant win for the environment and the future of sustainable fashion." They said the de minimis exemption has provided an unfair advantage to fast fashion Yeah, I would kind of agree with that second statement. But so the tariffs are not universally hated, but it seems like most business leaders against them. That was kind of the exception that proves the rule. We have about 5 minutes left. I want to take you through a little bit of a SONAR update. And this first chart is the outbound tender volume index. This is a measure of requests that shippers have to carriers made electronically for carriers to move loads. Is going to be across equipment types. And you see that the 2025 is in white, 2024 is that green line. So we are below the 2024 by, depending on the day of the week, somewhere like 8 or 9%. And kind of roughly in line with 2023, which wasn't really a great year for freight demand. And maybe in the last few days, we're starting to dip below 2023. So this is one that would encourage SONAR users to check every single day to see what happens with demand. I mean, it is such an uncertain time where is a consumer going to stop buying anything that's not discretionary? That would mean there's less replenishment of inventories that are close to consumption centers. That's going to see less tender volume. You're going to see this right away in SONAR. The next chart I have here is the tender rejection indexes by equipment type, and really seeing a wide divergence in tender rejection rates by equipment type. The white line, which is the biggest sector, that's going to be your dry van sector, and seeing that maybe rise a little bit, but not tremendously. The dry van tenders are being rejected about 5.5% of the time. So that still suggests there's a loose market by and large in the dry van sector. That's not true of every geography. We're starting to see some tender rejections increase in certain locations. You can look at SONAR in more detail for that. That red line is the reefer tender rejection rates. Are seeing some of that increase. Some of that might be due to seasonality, but one thing that we've noticed is that the tender rejection rates and the rates to move freight still kind of depressed in California to move produce from California to east to more of the consumption centers. So that's something that was maybe a little surprising. It seems like carriers are sending a lot of equipment out there because they know they can get loads, but haven't seen a lot of tightness in that market. Reefer carriers currently rejecting about 10.5%. Those rates do tend to be higher than the dry van rates in general. And the one sector that has really spiked a lot has been the flatbed sector, which is that yellow line. And really in response to the tariffs, what we've seen there is a lot of lumber that is moved from Canada to the U.S. It has taken a lot of the capacity out for flatbed. And so we saw those spike from, let's call it 10% tender rejection rate all the way to 40 plus. Currently it's at 30.5%. That is a much thinner data set. So it is going to be more volatile. The flatbed sector is a smaller sector of the trucking space. So those two things make it more volatile. In addition, my colleagues who have brokered the flatbed freight, including Grace Sharkey, say that, well, a lot of the flatbed is just moved on the spot market, so it doesn't go through the traditional sort of tender and accept or reject process. So that just makes the data set thinner, makes it more volatile. But nevertheless, we really are seeing a tighter flatbed market because of trying to avoid tariffs at the 11th hour. So that'll be one. We'll see where that settles out at. I think that's probably just a temporary blip. You have one more SONAR chart, which is the national truckload index, line haul only. So this is a measurement of spot rates. And up until the last week or so, we've sort of seen spot rates trend in line with the past couple of years, where the peak season for trucking tends to be between November and December, and then it's still kind of tight in January in terms of finding the equipment. You have weather impacts and those things, and the spot rates tend to fall the first few months of the year, and it's been kind of trending in line with 2023 levels, similar to what we saw with volume. But then in the last week, you started to see the truckload spot rates increase. And I should mention that there's a methodology where we're removing the impact of fuel on these rates. Spot rates include fuel generally, but we're using this kind of on a fuel neutral basis. And you are seeing those start to tick up. And so this is going to be one to watch on a daily basis. That may be partially because of flatbed rates are rising, but would encourage you to follow spot rates in SONAR, tender rejection rates in SONAR, overall tender volume in SONAR, among checking out your individual regions. So want to make sure you understand that and are signing up for the Stockout newsletter. With that, next week I'm sure we'll have much more updates and things will probably change dramatically by then. So hope everyone has a good one.